Okay. Now, let me turn on the light. Okay, let's see, we got this one. And just before we get started, anybody have any questions on anything? Doing good? All looking good? Okay, all right. Let's go ahead and, so what we have here now. Okay. So chapter 5, now everything you learned up to now, you can continue to use. We're just going to add some features. Okay, so chapter 5 deals with a merchandising business. Now, the merchandising business is different because it has an inventory. So we're going on to merchandising business. And let me put businesses. And what we're talking about with the merchandising business is it has an inventory. So it buys the inventory, it puts it on the shelf, marks it up, sells it to a customer. So we're talking about a retailer, or we're talking about a wholesaler. But it's a business that has an inventory that they mark up and then sell to the customers. They take title of the inventory. Okay? All right. The chain usually goes manufacturer to wholesaler to retailer to the consumer, to us. Okay, so the manufacturer sells to the wholesaler buys it in big lots, breaks it down into smaller lots, sells it to the retailer, who sells us individual items. Okay, now, what happens here now is it works a little different. So the income statement looks like this. What you have is you have net sales. And in this case, let me put up these numbers and then we'll take a minute and just talk about it. So net sales is $314,700. Then you subtract your cost of goods sold, and that equals $230,400. That difference of $84,300 is your gross margin. Now, this book uses gross profit. You always see it called gross margin. Okay. Then you take away your expenses, and in this case, the expenses are $71,400. That gives you your net income of $12,900. So, here's what the income statement for a merchandising business looks like. And now net sales, now don't forget, what net sales represents are gross sales, which is how much you sell, minus things like what your customer returns. Now there's more to it than that, but if you sell it and it comes back, it's not a sale. So net sales is a much more accurate number than gross sales, right? So net sales are it's how much you sell minus what the customer brought back. Okay? Cost of goods sold. This is how much you paid for the merchandise. So in this case, you paid your wholesaler $230,400. You marked it up and sold it to your customers for $314,700. And you marked it up by a total of $84,300. So here's how much you paid for it, here's how much you marked it up, here's how much you sold it to your customers. Then you subtract your store expenses, your wages expense, your rent, insurance, all that, and then that gives you your net income. And the reason it's done this way is because it's important to know how much you're marking things up so you're just consistent. And of course, that's the very core of how you do business. So for instance, if you're a mass merchandiser like Walmart or Kmart, you have a small markup. And that's your whole business is based on that small markup, huge volume, a little bit each item, but you sell it a whole bunch of times, big bucks, right? If you're a small boutique, in that case you have a much smaller volume, therefore you have to have a much larger markup. But you offer services, expertise, ambiance, and all that sort of thing, and it's worth it, okay? But you gotta keep track of this, because if Walmart marks the goods up too much, they change their business model, and people can go elsewhere, okay? If they mark it up too little, well, that's not good for business. And the same with the boutique. You have to mark it up enough that you can make a profit, okay? Nordstrom's, for example, has a much higher markup than Walmart, but they have all kinds of services. So for instance, there was an old joke. You buy your tires at Walmart and you return them to Kmart. Well, the deal is, you buy your tires at Nordstrom and you return them to Kmart. Maybe it's been a long week for me too, okay. And that was a joke. Now Walmart or Nordstrom's doesn't sell tires, but they have this incredible, or they had this incredible return policy. But there's no free lunch. You offer customer service like that, it's expensive. And that expensiveness requires you to have a huge markup. So you gotta make sure. So that's why it's separated out this way. It's because it's just how you do business, and you can't deviate from that too much. And if you do, it just means you're doing different, you're just doing business differently, which is maybe not, which is, yeah, there you go, thanks. Okay, all right. Everybody got the roll, right? Okay, all right. Now, here's kind of how a lot of this stuff fits together. So, and this little diagram will explain much of how the chapter fits together. So, you have your beginning inventory, and you have your purchases. Okay. Now, by the way, often you'll see, in this book, you'll see the term net purchases. Now, net sales is how much your customers bought minus how much they brought back, right? What do you think net purchases are? It's how much you bought from your wholesaler minus how much you returned to your wholesaler, okay? Now, by the way, there's a couple other things that go into net sales as well as a couple other things that go into net purchases, but the idea is the same, okay? Now, together, these are merchandise available for sale. So your purchases plus your inventory, beginning inventory, those two together is how much you had available for sale during the accounting period. Then at the end of the accounting period, you have your ending inventory. And your ending inventory is how much you didn't sell. And what you did sell shows up as cost of goods sold. And of course, this cost of goods sold, I'm going to get a different color marker here. This cost of goods sold is that cost of goods sold. Okay? So, and again, this little diagram will explain much of what happens in this chapter. So, you have your beginning inventory, which is carried over from the last year. You add your net purchases, which is how much you bought minus how much you returned. Together, they constitute how much you had available for sale. Then at the end of the year, this available for sale can only go into one of two categories. Either it's still in inventory, right? You didn't sell it. Or if you did sell it, it shows up as cost of goods sold, and this cost of goods sold is an expense. So when you sell it, you convert it from an asset into an expense. Okay? And cost of goods sold, we could just treat it as though it were an expense. Technically, it's a little different, but for all intents and purposes, just considered to be an expense. Okay? And this is the expense of paying for goods that you've sold. All right. Doing good? Questions, comments? All right. Now, there's two ways of doing inventory. So this is inventory systems. One is the perpetual, and the other is the periodic. Now, in the perpetual, what you do is you update all sales accounts on every sale. So what that means is, if you buy something from a store, you know they have that barcode on there? When that clerk runs the barcode across the scanner, then sales is updated, cost of goods sold is updated, and then inventory is reduced, okay? So all those accounts are updated in every sale. The advantage to this is all the accounts are current and you can manage your store better, okay? Now the periodic, what it does is it calculates the cost of goods sold only at the end of the accounting period. Now, by the way, I know this is kind of a little small writing, but if I do it this way, then at the end of the period, we can review everything. And I think that review is worth a lot. I think it moves it into long-term memory. I just really think that makes it more memorable. So if I put it here, then I won't have to erase anything. Is the reason I'm doing this. All right, so as far as the periodic goes, now what it does is it's true that it doesn't keep your accounts current, right? But what it does do, and I'll show you why this later, it gives you a lot better information to make decisions with. So what some stores do is they use the perpetual system on their day-to-day business because they can keep top of everything. They know how much is left in inventory, etc. And then they report using the periodic methods on their annual reports because this is the better way for making decisions. And that way they have the best of both worlds, okay? So this is good for managing, everything's current, right? And then this gives you better information. And I'll show you what ways later on in the chapter. Okay? All right. Now, let's do this. Okay. There's discounts. And there's two kinds of discounts. There's a trade discount and there's a cash discount. Now I'm going to move that camera so that when you guys check this thing out at home, you'll be able to, okay. All right. So a trade discount and a cash discount. Now, the trade discount, what happens here is this determines how much you pay for the goods. So you have one catalog that serves several customers, several categories. Okay, so you have one catalog, but you can serve several categories of customers. So let me show you. You have a manufacturer. Now that manufacturer says, listen, if you buy in lots of 1,000, I'll consider you a wholesaler and I'll give you a 60% discount off of retail. Okay? So let me start out. If you're a manufacturer, first of all, you list the catalog. And the catalog has suggested retail. That's the one you see used often. Your textbook calls this the list price, okay? Both names for the same thing. So the catalog's suggested retail. So if you or I call up the manufacturer and say, I'd like to buy this, they'll say, here's what it is, here's how much you pay. You and I pay suggested retail, okay? But that same catalog goes to the wholesalers, and what it is, for example, this manufacturer can say, if you buy in lots of 1,000, we'll consider you a wholesaler, and we'll give you a 60% discount off of suggested retail. So, the wholesaler gets a 60% discount off retail. Okay? Suppose you, and the manufacturer says, if you buy in lots of 100, I'll consider you to be a retailer, and you get a 40% discount. Okay? And by the way, as everybody knows what I mean by retailer too, that's just a store you shop at, right? Walmart, Kmart, Sears, Nordstrom's, okay? So the advantage here is that you can have one catalog, right? And rather than have one for the retail, one for us, one for the wholesaler, and one for the retailer, rather you have just the one catalog that has the suggested retail, and then these two get a discount off of that. And of course, 60% discount, they'll then mark it up and then sell it to the retailer. The retailer will then mark it up and sell it to us. And again, what it does is it's a lot better way of doing business instead of having a whole bunch of catalogs, which is a lot of expense and confusion. You just got the one catalog, everybody uses it. And in this case, the three categories of customers were based on volume. Okay? And now the trade discount, it determines how much you pay, but none of this 40, 60%, none of that shows up in your accounting records because you record your assets at cost. Okay? So you just record what you pay for them, but this determines what you pay for them. Does that sound good? All right. Michael, I see a quizzical look. The wheels are turning?
Nope, good to go.
Good to go. All right. Sounds good. All right. Cash discount. Now this is a reward for prompt payment. So the one that, and this used to be much more common than it is today. Whether you use this depends on what industry you're in. Some industries don't have it, others have had it for years and continue to use it. One that you see is 210 net 30. What this means is you get it, if, for instance, if your wholesaler offered you this, what it says is you'll get a 2% discount if you pay your bill within 10 days of the date of the invoice, right? Or you can choose to keep it an additional 20 days, but it's due 30 days after the invoice, right? But if you pay it within that first 10 days, you get a 2% discount. Now, what this does is it improves the wholesaler's cash flow, and it lessens bad debt. So when the bill shows up, people are more likely to pay you, and if they pay you and a short of money, somebody else doesn't get paid, so your bad debt goes down. And because you get paid sooner, you have better cash flow. Now, somebody over there is thinking, 2%? I'm a busy guy. I haven't got time to fuss around with 2%. My Lord. Well, Steve's saying that. Well, let me show you this, Steve.
No, I know, it adds up.
Oh, yeah, it does add up. But let's so what it is any number by itself is just hard to make sense of. You've got to put it in some sort of a context, right? So instead of having 2% for, let's put it as annual APR. Because then if you compare your credit card, that's also expressed in APR, and you can compare your credit card to this, right? They're a common basis. So what happens here is the date of the invoice. You can keep it 10 days, and get your 2%, or you can keep it an additional 20 days and lose the 2%, right? And we're assuming that good credit is worth having, so you pay your bills on time, right? So you forego the 2% to keep it 20 days, right? Okay? So let's deal with the banker's year. So let's say a banker's year has 360 days in it. Here's the 20 days. This 20 days occurs 18 times in a year. Does that sound about right? And every time you have this option, it's worth 2%. That comes out to 36% APR. So what that means is if your credit card charges you 18%, you'd be ahead by putting it on your credit card, getting hit for the 18%, but save the 36%. Okay? So 2% sounds like a pretty piddling amount, but like Steve said, it does add up. And it's worth scheduling on it. And of course, you know, when you do your accounting, you'll do your accounting with a computerized system, QuickBooks, Peachtree, or whatever, and you can enter this easily. When you open the program in the morning, it will tell you what bills need to be paid to take advantage of these discounts. Okay, all right. Okay, you doing good? Any questions on that? Comments? All right. So let's do this then. Let me turn the camera around and let's get into the actual journal entries for, oh, here we go. All right, everything's on there. All right, let me turn this around. Let's get into the journal entries. Okay. All right. So in this case, here's the example. So on November 2nd, Z-Mart, the name of the retailer, Z-Mart buys $2,000 of merchandise. And the terms are 210 net 30. Okay? So what happens here is the journal entry is November 2nd. You're going to debit merchandise inventory. For 2,000. And you're going to credit against accounts payable for 2,000. Okay? So, what kind of an account do you think merchandise inventory is? It's an asset, right? So what it is you bought it. Now, why don't you take the 2%? Well, the 2% is taken when you pay it. Because at this point in time, you don't know whether you, so it's taken when you pay it. Okay? Now, in this case, let's go up to November 12th. That's 10 days later, it's within the discount period, and you pay it. So, accounts payable will be debited for 2,000. Okay, because you're paying off the whole thing, right? I'm just going to put an arrow. This is 2,000, is that 2,000? And now let's take a look at this. You paid it in the discount period, so you qualify for the discount. So let's have this. So $1,200 times 2% equals 24. So you qualify for a $24 discount because you paid it in the discount period. Does that sound about right?
How is it, you said $2,000 worth of merchandise, so how is it $1,200 you only get the 2% on?
Oh, I said 1,200. Yeah, you guys, thank you.
Oh.
Okay, yeah, thanks. Oh, I'm sorry. Listen, here's what I did. Let me do this. Okay. Let me change this. Let me change. If you guys are okay, so let me change all these. It'll make it easier if I change all these to 1,200. Okay. All right. Is everybody okay with that now? Okay, all right. Now, and then 1,200 times 2% is $24. Now, check this out. Now, here's what we're going to do. See if, let me put this up here, and we'll see if it makes sense. So now, merchandise inventory is credited for 24. 1,200 minus 24 leaves a balance of 1,176, and that's a credit to cash. So here's when you pay it. Okay? Now, does everybody see how I calculated the discount? You okay with that? Now, I took the discount, so this is the discount. And I qualified for the discount because I paid within 10 days because it's 210 net 30. Now, why in the world did I credit the merchandise inventory account for $24, the amount of the discount? Why did I do that, do you think?
Because you have to account for the $24 somewhere. You're not gonna pay $1,200 in cash because you got the discount. Since you already purchased the inventory, technically you're making your money back when you sell the inventory. You get the extra $24.
That's true, sure. Pretty close. What if I think you're pretty close. The deal is, the reason we do it this way is because, don't forget, every asset is valued at cost, right, what you pay for it? So when you get a discount, the cost of your inventory is decreased by $24. And of course, everything's recorded at cost, the cost becomes less, the value of the inventory becomes less. Okay? And what you say is true, Kirsten, when you sell it, then you make more money. That's true. But the reason you credit merchandise inventory is because the cost of the inventory is less, therefore the value of the inventory is less. Okay? All right. Now, okay, so, now by the way, don't forget, all of this, we're going to talk about sales in a minute, right? And we're not talking about sales here, we're talking about purchases. And purchases, there'll always be a cost. Now later on, we'll talk about sales, we'll talk about retail price, but that's not what we're doing here. We're talking about cost, okay? Now just for the heck of it, what would this have looked like had they paid it on November 14th? There was no discount. Well, if this was paid on November 14th, then let's just kind of go down here and put this in here. So if it's November, I'll erase this so there's no confusion. If it was November 14th, then what you would have done is you would have done accounts payable for $1,200 and then cash for $1,200. So if it was after the discount period, then it would look like this. Okay? And maybe I'll leave it up here. I'll put after discount period. Pay bill in discount period. Okay, all right. Now, we have a purchase return. So what we're doing, so the next step, and all this is purchases, right? So the next step, in this next example, Z-Mart, okay, returns $300 of merchandise to the wholesaler. So what happens in this is, for some reason, some of this merchandise proved to be unacceptable and you're returning it to your wholesaler. So when you do that, and let's say it happens November 15th, when you do that, you're going to debit accounts payable for the $300, and you're going to credit merchandise inventory for the $300. Okay, so this is what a merchandise return looks like. All right, does that sound pretty good? Or a purchase return, and this purchase return looks like. And what's important to say, this is all the perpetual system. So we're dealing with a perpetual system. Now, when we do the periodic, and we'll just review it, it'll look different. But on the perpetual system, this is what it looks like. All this making sense? Okay, now, so let's kind of go over this. So when you buy merchandise, yeah.
I have a question. So like for accounts payable for the November 15th one,
Mhm.
why is it accounts payable? And who would it be on? Would it be on the retailers or the wholesalers? Like accounting.
We're talking about the retailer,
Okay.
because, and what we're talking about here is, if you're the retailer, you're purchasing goods for resale,
Mm-hmm.
right? Now, by the way, there were some transactions in here, because this one zeroed out all the accounts.
Mm-hmm.
So, but there were intervening transactions. And so, would assume you bought the additional merchandise on this basis. Now, had you set it in and they would have sent you the cash, then you'd debit cash.
Okay.
But this is the basis it would work on, okay?
Okay.
All right. Okay, all right, any other questions? So you're, okay. Now, here's the deal is, and this will feed into that too, Cameron. What you did is, you returned this $300 worth of merchandise to your wholesaler, right?
Mm-hmm.
And that wholesaler would have sent you, and the wholesaler says, yeah, it's damaged, we're gonna give you your money back, right? The wholesaler would have sent you a debit memorandum. Okay? Now, don't forget, there's debit memorandums and credit memorandums. What this describes is what happened on the sender's books, right? So now, this is all from the retailer's point, on the retailer's books. So the reason it's a debit memorandum is because this is the wholesaler's books, this is the, okay. So here you have assets equals liabilities plus owner's equity. Here you have Z-Mart's account, and it's an accounts payable. And what you're doing is you're debiting this account for $300. So the word debit describes what happened on the sender's books, okay? Because there's debit memos, there's credit memos. And it'll be a debit because the account was debited on the sender's books, on the person who issued the memorandum, okay? Your bank, well, the bank by contrast will send you a credit memo. They'll credit your account. And it's because they're describing what happens to their accounts payable because they now owe you more money. Did I confuse people with that last statement? You want a demonstration? So that's why it's called a debit memo, is because they're debiting your account. Okay? Kirsten, how you doing over there? Is this all making sense? Okay. Any other, are you guys doing good? So, let's just briefly review this. When you buy merchandise, you debit the merchandise inventory and you credit accounts payable, right? Merchandise inventory is an asset. You don't take the discount at this point in time, you take the discount if you pay it within the discount period. Well, they do pay within the discount period. So then what you do is you debit accounts payable for the amount of debt you're wiping off. You credit your inventory account by the amount of the discount. And it's because assets are valued at cost, the cost just decreased. And then you credit cash for the amount you actually pay, which is what you owe minus your discount. That's how much cash you paid. Had you paid it outside the discount period, so instead of paying it on the 12th, you paid it on the 14th, then you would debit accounts payable for what you owe and credit cash for the full amount. When you return goods to your wholesaler, what it is, and when the wholesaler approves it, the wholesaler will send you a debit memo, because the debit memo describes what's happening on the wholesaler's books. The wholesaler's debiting the account, your accounts payable, okay? And in this case, what you do is when you return goods, you debit accounts payable and you credit merchandise inventory. You know it's no longer an asset in your books and you no longer owe. Okay? Does that sound good? All right, let's practice this before we move on. So let's do quick study 5-3, and you find that on page 209. Now I'm going to turn that camera around. Let's put it on the board. See, I'm gonna step past you, make sure I don't knock your book over. Okay. This will make it a lot easier to read. All right, here it is. So prepare the journal entries to record each of the following purchase transactions. And again, it's important to realize, right now, we're only dealing with purchases. Later on, we'll deal with sales, but you're only purchases, and you're a retailer, all right? A transaction of a merchandising company, show supporting calculations, assume the perpetual inventory system, which is the one we've been working with. So on March 5th, you purchased 500 units of product, it costs $5 per unit, in terms of the sale are $2.10. Now this is net 60, so 2% discount if you pay within 10 days, but it's due within 60 days of the invoice. Okay, the invoice is dated March 5th. You returned 5 defective units on March 5th, okay, and received full credit. And you paid the amount due on March 5th, March 15th. So you paid within the discount period. Now don't forget, don't take a discount on merchandise you return. Let me give you a heads up. Now, does everybody got the roll? Okay.
So then if that's the case, don't you technically only get the discounted rate on the merchandise you returned in this example too? Instead of full credit?
Well, now by the way, don't forget, first one, yes, you're right. But now don't forget, we paid the bill on the 12th, and then we returned the merchandise on the 15th. And there were intervening transactions that we just didn't show. On this one, it doesn't apply.
Okay.
Simply because this transaction happened at a future date, it's totally unrelated.
Okay.
And we bought additional merchandise.
Okay.
Yep. All right, you guys ready for the answers? Okay, here you are. So let's just kind of go through these a step at a time. So what you did is you bought 500 units, they're worth $5 each, so you debit the asset merchandise inventory and you credit accounts payable. This is when you bought it. Now you pay it, now what you do is you return some of the merchandise. So what happens on this thing is you return, what, 5 units? Okay, so when you do that, you're returning $250 of merchandise, so you debit accounts payable and you credit inventory. So the asset goes down by what's gone, the liability goes down by what you don't owe. Okay, and everything's at cost. Then when you take the discount, so what happens to this is you originally bought 2,500, okay? You return 250. So that means 2,250 is what's left, and you take 2% of the 2,250, so the accounts payable goes down by what you owe. Cash is credit, so then you take the discount of $45, and the difference is how much you pay, which is cash.
Does it matter if you write cash or merchandise inventory first?
No, either order will, either order. Now, when you do the manual system, the answer to your question would have been, if you keep everything in the same order as the chart of accounts, you're less likely to make an error, okay? However, because you'll do it on a computer, it makes no difference.
It'll do it.
Yep, it'll do it, yep. But if it was a manual system, by the way, it's not gap or anything, it's just a good practice. No, yeah.
So how do you get the 2205? Can you go over that for the
Sure.
cash?
Well, what happens here, now this is the total amount you owe after the return, right?
Yeah.
All right, and you get a 2% discount. So 2% of 2205 is $45, so that's the amount of the discount.
But where'd you get the 2205 from?
Well, because you originally bought 2,000, you originally bought 2,500 worth of stuff, right?
Uh-huh.
And you returned 250.
So
So you
that you-
still owe that amount.
Okay.
2205 is 2250 minus 45.
Oh, okay.
Oh, I see, the 2205 is, yeah, now you get, so this minus the 45 gives you the 2205.
Oh, okay.
Yeah.
It was just the order.
Yeah, I agree with you. I would have been much more comfortable had they reversed the order. It would have made more sense to me too. Yeah. You guys doing good? Okay, good. All right, you guys are doing good. Let's do one more concept. Well, people are still writing. Take a minute here. Well, it's been a long week, hasn't it? It really has, and yeah, those darn tests, you know, yeah, grading them was, taking them's a pain, grading them's a pain. You know, it really is, and there's 63 of those, 62 of those things. So it was a pain.
Don't worry, as the term goes on, there's a decrease.
But, yeah, that's true. And yeah, and this was a paid to grade, but there tend to be more multiple choice from here out too, so it's easier with me too. All right, you guys doing good? Okay, so listen, let's do this. Let's do one more thing. If we do one more thing, then we'll be able to move on to a different topic when we get back. So let's just do one more thing. We'll take our break, and then we'll move on to a different topic. Okay, so let me move that camera around so it will make sense. And what we'll do is after the break, we'll move into sales. Right now we're into purchases. So everything we've done so far has all been purchases. Now, transportation. So let me start out with the idea that every asset is valued at two things: what you pay for it, plus what it costs to get it in usable condition, right? So if you buy a car, it's buying the car, there's some taxes involved, like a few $1,000s in taxes, that's included in the cost of the car, the value of the asset. Suppose you had to have it detailed, suppose you had to have it shipped from where you bought it to where you're going to use it. All of that stuff is in the cost of the asset. So every asset is valued at what you pay for it, plus whatever it costs to get it in workable order. Okay? Now, here's transportation. So here's the wholesaler. And here is the retailer. By the way, Candy, could you move that? Because I sure appreciate it. And it'll be a matter of time until I trip over that thing. All of you will laugh at me. All right, here's the retailer. All right, here is a truck. okay? And the goods are being shipped from the wholesaler to the retailer, okay? That sound fine? Now, what we have here is, there's FOB. Now, FOB stands for free on board. It seems to me if it said freight on board, it would make more sense. Okay, but it's free on board, okay? And what it does is it describes where the title changes hands. Okay, tells where title changes hands. Okay, and this would be FOB shipping point. So what this tells you, if it's FOB shipping point, it tells you that the title changes hand here, that ownership changes hands here, right? So if the ownership changes hands here, who owns it in transit? The retailer, the buyer. Who's responsible for the shipping charges? The buyer. Okay? So what this says is the buyer owns in transit. And the buyer pays shipping. Okay? All right. Now, what if it says FOB destination? This describes that the title, this states that the title changes hands when it arrives at the buyer's dock, right? Who owns it in transit? The seller, yeah, the wholesaler, exactly, the wholesaler. And pays shipping. Okay? All right. Now, in this whole thing, we're the retailer, because so far, all of what we dealt with today has been buying merchandise, right? We're the retailer, we're buying merchandise for wholesale. So what it is this, so let's say, okay, so in this case, let's say the shipping charge is $75. What that means is, we're the retailer, and I'll put it up here, so we retailer, okay? Okay, and we'll put buyer. Okay, kind of, we're saying the same thing. When we do that, let's say November 24th is when the transaction occurred. We're going to debit merchandise inventory. For $75. And we're going to credit, let's say it's cash, could be accounts payable, for the $75. Okay? So we're the buyer, we're the retailer. It's FOB, in this case, it's going to be FOB shipping point. So if it's FOB shipping point, that means we bought it here, we owned it in transit, this is what it looks like. Now if it's FOB destination, that means the seller or the wholesaler owns it, the wholesaler would pay it, and it would show up in his or her books. Okay, but we're the retailer,